With stocks surging one moment and plunging the next, it's harder to stay focused on the long term. So here are some key facts to stay focused on during this volatile time. Over the 91 years from 1926 through 2016, a portfolio diversified across bonds and cash, as well as large and small company stocks, averaged a 9.6 annual return and a 16.6 standard deviation. Standard deviation is a measure of risk. That's more return and less risk than any of the four types of investments, making it a more efficient investment. 91 years goes back to when stock returns were first recorded on Wall Street, but most people don't invest for 91 years. Yet, the important fact to focus on is the longer you invest, the more likely you are to experience a return equal to or better than the 91-year annual average of 9.6%. To illustrate that fact, here are rolling 12-month returns averaged over different holding periods. Over 35 years, large company stocks beat the long-term average return of 9.6 in a whopping 88% of the 91 years. Over 10 years, they managed that only 46% of the time. And the longer you invest in the diversified portfolio, the more likely you are to experience the long-term return and risk statistics. After a record closing high on Friday, January 26th, stocks plunged to a low of $25.32 at 1:39 p.m. Eastern Standard Time on Friday, February 9th. An 11.8% plunge, and the correction may not be over. Volatility has risen, and investors have been spooked by rising inflation expectations, higher lending rates, and growing concerns over the long-term U.S. debt. Statistically, the chance of a bear market decline of 20% or more increases as the 8.5-year bull market grows older. And the new tax law increases the chance the Federal Reserve will make an interest rate policy mistake by quashing growth or allowing the economy to overheat and inflation to surge. Fed mistakes caused every recession in post-World War II history. However, earnings drive stocks, and earnings expectations have been surging, bolstered by the new tax law. When the new tax law was signed in late December, the average company in the S&P 500 was expected to see profits of $131 a share in 2018, but that was revised to about $152 and could be boosted again in the weeks ahead. With real wages continuing to grow, consumers are spending, and consumers account for 69% of economic growth. Despite inflation worries looming larger, there is no sign of a recession, and major economic indicators are signaling strength. So, despite the correction, the bull market and economic expansion could continue for months and head much higher. Stay focused on the long term.